The market just handed us a masterclass in human psychology disguised as a routine trading week. While most traders are confused by the mixed signals, the Dow hitting all-time highs while tech stocks crumbled, I see something far more valuable, a predictable pattern of human behavior creating systematic opportunities. This isn't chaos. This is the market doing exactly what markets do when participants get caught between competing narratives, and understanding this pattern is how disciplined investors exploit the crowd's emotional swings. If you've been watching the rotation out of AI stocks into small caps and cyclicals wondering what it means, or if you're trying to make sense of a Fed that cuts rates while signaling they're nearly done easing, then you need to understand what's really happening beneath the surface. Because this isn't about individual stock picks or trying to time the next move. This is about recognizing a systematic shift in market psychology that creates exploitable inefficiencies for those who remain disciplined. I'm going to show you how to read these signals through the lens of human behavior, how the system amplifies these psychological patterns, and most importantly, how the Stoic approach positions you to profit from the crowd's predictable reactions. Let's break this down. The human layer of this market tells a clear story. We're witnessing classic late-cycle psychology where participants are simultaneously afraid of missing out on year-end momentum and terrified of being caught in overextended positions. This creates a fascinating dynamic, surgical rotation rather than panic selling. When Broadcom dropped 11.4% and Oracle fell 4.5% despite delivering strong absolute results, the crowd wasn't rejecting these companies. They were repricing inflated expectations. The psychological anchor shifted from growth at any price to margin sustainability. This is human nature. When a narrative gets stretched beyond reality, even good news becomes disappointing if it's not extraordinary news. J.P. Morgan's characterization of consumers as fragile injected doubt into the soft landing narrative at precisely the moment when confidence was highest. The herd responded predictably, defensive positioning even as the Dow and Russell 2000 printed fresh highs. This cognitive dissonance, celebrating new highs while hedging for downside, is textbook human behavior under uncertainty. The Fed's divided 9-3 vote created another layer of psychological tension. Market participants received their expected rate cut but were simultaneously told the easing cycle is nearly complete. The human mind struggles with this contradiction, leading to the rotation we're seeing, taking profits in crowded trades while hunting for unloved value exposures. Now here's how the system amplifies these psychological patterns into tradable opportunities. The S&P 500 declined 0.5%, while the Dow gained 1.2%. This isn't random noise, it's capital flowing from growth to value in real time. The Nasdaq's 1.9% weekly decline confirmed the AI trade was under systematic pressure. But notice what happened on Friday. The Russell 2000 and Dow hit all-time highs before reversing. This is a classic exhaustion signal where new highs fail to hold, indicating the system is testing resistance levels and finding sellers, not buyers. The bond market provided the clearest signal. The 10-year yield spiked to 4.19% earlier in the week before retreating. This was the market testing the Fed's resolve. When the Fed announced Treasury bill purchases, the system interpreted this as liquidity management, not a dovish pivot. The yield retreat confirmed the Fed's credibility on their hawkish guidance. Sector performance revealed the game theory at work. Technology and communication services led declines while energy, financials, and industrials outperformed. This is textbook late-cycle rotation, when the system anticipates slower growth and higher for longer rates. The VIX remaining subdued near 15.78, despite this rotation creates an asymmetric setup. Low volatility during leadership changes often precedes volatility expansion when new data forces reassessment. Here's the most important insight. The system is repricing AI capital expenditure stories from growth certainty to margin risk. Broadcom's margin pressure warnings and Oracle's revenue miss, despite 14% sales growth, show the system demanding capital allocation discipline over narrative momentum. The Stoic approach to this environment is clear. Observe without emotional attachment, focus on process over outcomes, and position for volatility rather than direction. First, recognize that this rotation is healthy rebalancing, not structural breakdown. The Russell 2000 and Dow hitting all-time highs, while the Nasdaq declines isn't contradiction. It's diversification of leadership. The market is becoming less concentrated, which reduces systemic risk. Second, the Fed's hawkish guidance clarifies the landscape rather than complicating it. Terminal rates are repriced higher, which compresses multiples on long-duration assets but supports financials and value. This is exploitable through systematic sector allocation rather than individual stock picking. Third, the delayed macro data creates symmetrical blindness. All participants are waiting for November jobs and CPI data. The Stoic exploiter uses this fog to prepare rather than predict. Position for volatility around the releases rather than making directional bets on outcomes you cannot control. Fourth, the cannabis sector's 28 to 33% surge on policy speculation demonstrates how quickly mispriced regulatory risk can correct. This reminds us that catalysts often emerge from outside the consensus field of vision. Maintain exposure to asymmetric opportunities in unloved sectors. The key insight that ties this all together is that we're not witnessing market dysfunction. We're seeing the system work exactly as designed. Human psychology creates predictable patterns of overextension and correction. The AI trade became overcrowded, margins compressed, and the crowd rotated. This is mean reversion, not crisis. The disciplined approach is to let this rotation complete rather than chase it. Wait for technical confirmation and valuation support in the new leadership sectors. The market is not expensive in aggregate, but it remains expensive in pockets. Patience and process will be rewarded. The consensus is positioned for soft landing and gradual disinflation. Any deviation from this script, whether hotter inflation or weaker employment, will create systematic opportunities for those who remain disciplined and prepared. Remember, the market will do what it does. Our task is to observe, adapt, and exploit the gaps between perception and reality. This week's action provided a perfect example of how human psychology creates systematic inefficiencies for those who maintain Stoic discipline. What patterns are you seeing in your own analysis of this rotation? Share your observations in the comments. I read every one and often find insights that enhance the framework. And if this approach to reading market psychology resonates with you, subscribe for more systematic analysis that cuts through the noise to find exploitable opportunities.